It is 7 p.m. in Geneva. Micro speaker already told me that you can see and hear me quite well. Um, Hearing me is okay. Watching at me, I'm very far from being a Hollywood star and very far from being beautiful and handsome, which is not the case for my today's co-speaker, Brett Morris. Ladies and gentlemen, I welcome my co-speaker, Head of Credit Management, Dell, Mr. Brett Morris. I mean, if we're in studio, we're supposed to say something like this, but I believe people do that. How are you today, Brett?
I'm wonderful, and yourself.
Not bad, not bad. Thank you. So, our today's topic is rethinking the use of credit data. I believe you're ready to that. And even if you're not, it will be even better, as I said, just beyond the air today. So today I would like to start from an announcement. And I will quote a lady. I mean, the quote which I would like to use is normally assigned to Eleanor Roosevelt, who used to say that, according to sources, who said that, small people speak about other people, average people discuss events, great people discuss ideas. When preparing for today's air, I was thinking what I would like credit charts to be. And I came to conclusion that I would like credit charts to be a place where people discuss ideas about credit management.
Yes.
So, like, what credit management will be tomorrow? How could it be? What can we do better? What can we do more interesting, even funnier, if you wish?
Yes.
So that's my biggest surprise for today. So starting from this issue of credit chats, we are mostly discussing ideas, and we're discussing. I want great people discuss great idea, and thanks God, I managed to get one great man today.
Okay. Well, thank you very much. I'll and just for what it said, if anybody learns or benefits from anything, that's completely that was never the intention. If you do learn something, that's quite a surprise. So from me. But yes, it's certainly a landscape that's changing quite rapidly. Before us, we're crawling out from COVID in a lot of cases on our hands and knees, more so the UK, which is effectively what takes up most of my day, where you still have some of the highest inflationary pressures that are going to persist within the certainly within the G7 countries for for the next 1 to 2 years, and that is having a great impact upon the certainly upon the buying decisions, both on a short-term basis and a long-term basis. I spend most of my time currently. I'm looking after the leasing portfolio of Dell Financial Services, and that's a very interesting sense in that when COVID came and when there was a lockdown, and a lot of companies had to then, through no will of their own, they had to embrace the remote working. A lot of companies found out that their IT backbone was ill-equipped to handle the remote working. You had people who, let's say, just had the old-fashioned larger desktop PCs, so they then had to be transformed onto maybe a laptop, something a little more portable. Not only that, you had the server environment that had to be upgraded to take a more remote networking. Now, what's happened is that all of that has now been and gone. And I think the next cycle of IT refreshing, for example, is going to happen probably, I would say, 12 to 18 months down the track. So for me, it's a bit of a quiet right now. But that means what you want to see is that as companies come out of COVID and as they move into, let's say, a rather difficult economic environment, this phenomenal headwinds that is going on around us. We're going to see a lot of companies now thinking we just want to crawl out of the next 2 or 3 quarters managing our cash flow. Now, if it's capex, what you'll find is that the fixed assets will be, for lack of a better word, sweated out, which means that if they had an economic life typically an economic life of 5 years, you'll see this written down 5, 7, from 5 to 7 years, as companies think if the equipment, be that IT or be that manufacturing, if it's still working, we're not necessarily going to replace that, because what we don't want to do is look down the barrel of retrenching our workforce, cutting back on opportunities, not being in a position to market aggressively. Those sort of budgets are going to happen. So certainly now it's a very interesting time. I think credit people have got to be on their guard, and the credit data that they have has got to be, I think, far more top of mind. And it's going to be interesting to see how, I suppose, certainly the people on here, but credit folks at large are going to work in an environment where there is much more difficult inflationary and interest rate headwinds.
When you say inflation, and because you mentioned that the biggest impact in your, so this is, by the way, Russian way of answering the question, how are you?
Okay. Of course.
Because
fine, thanks. Have coffee. What else could go wrong?
Yeah, absolutely. But when you say inflation, what inflation literally we're speaking about?
This is, if you just start at the headline figure, you're doing well. So
no, I was just about, like, if you can give me, like, what is the expectation of inflation in the UK and Europe based on your environment? Because you see, I'm coming from the environment when I started to do credit management, inflation was about 100% a year. And we used to work with interest rates 100, 120, 150%. And what I'm speaking about, since we are refreshing what is around us, is that what I can see, okay, inflation is better than usual. It is like 10%, 8%, but not greater. And are we on the same page with that? So the inflation is growing, which means, and it drives the growth of the interest rates.
Yeah, so
cost of credit becomes higher. Is that about that? But it is not dramatically high. It's not like credit used to cost 5%, now it costs 25%.
Yeah, it's not quite. What you'll find is that if you're talking about what is in terms of what is the cost to the customer in terms of credit, certainly in the shorter term, and we're talking lending under, let's say, 1 year, the capital cost is going to be far more impactful as to what the repayments are versus the interest rate. As you stretch that out, as you get longer and longer, interest rates become more profound, and there's a high level of elasticity when you get out to, let's say, property mortgages, for example. But right now, in EU inflation is said to be about 8.5. In the UK, it's about 10. Thank you, Brexit. It is going to get down to about 6.4 at the end of the year. Rishi Sunak would like to match that in the UK. I think he is going to struggle because of the continued frictions with Brexit, and, let's face it, the continued friction and some might call corruption that is starting to now be seen at a political level in the UK.
Yeah, that's clear. So, inflation is growing, cost of credit is growing, but things got too many companies, much bigger number of companies managed to survive during the COVID.
Mhm. Yeah.
And I expected much more dramatical change, honestly. And interestingly, I expected significantly higher default rates, which happened. But in terms of default rates, how did you find this COVID and post-COVID situation? Because honestly, I was thinking about, if COVID will continue with all these issues, like another year after the two, I expected economic collapse. Maybe too emotional, but how did you see that?
Looking at what when I was during the COVID epidemic, or now as we come out of it, or going
Yeah,
forward.
okay, let me explain. My expectations in 2020 was extremely bad. I was expecting extremely bad events, like, I don't know, but whatever you can name, it's end of the world.
Mm.
Nearly that, even in Switzerland. Then 2021 was already soft in terms of, measures put by governments. But still, there was a high expectation of extremely bad events in terms of, defaults, growth, and so on. But honestly, I'm sorry, I am not a corporate credit manager right now, so I don't got my brand connected to credit portfolio as usual credit manager do. Therefore, I'm really interested to know, since we are still refreshing, what is your, like, if you can recall your expectations in terms of bad debts losses and in terms of defaults in 2020 and what it is now. So when we see the reality, was it the big difference between the two?
Yeah, 2020, we had a rather intense moratorium program in place that was monitored at credit committee level, at our internal credit committee level on a weekly basis, making sure that the customers that approached us and said, "Hey, the government have shut us down. We don't have any cash." We were expecting that. However, it's ironic. Most of the ones that did approach us were larger corporates that were impacted, as you can imagine. Let's say the biggest one that we had trouble with was tourism and the leisure industry. So they came, but a lot of those were bigger players anyway. So you're talking about maybe some of the airlines, some of the cruise lines, some the maritime cargo, not so much because they were still needed, and they have rather sophisticated corporate lending sitting behind them. So they were very much, I think, at the behest of their shareholders, saying, ask everybody to defer as much as you possibly can. And there was also a lot more granted to them in terms of, let's say, emergency funds, accordion lines, and so forth. So we were expecting the end to come. It didn't happen as bad as we expected. And I think, for better or for worse, because there was an easing of restrictions and an easing of a return to normal. The sharp the cliff face that we're expecting didn't happen, and there was a return to normality. Certainly, when the infection rates started to stabilize and vaccine rates took up, so that kind of really helped to do that. I think the other thing, and maybe we'll get onto it later, was because a lot of the lending that was done by banks was done over the last decade on a rather benign economic front, certainly with interest rates of zero. It was in some cases less. So there was plenty of money, plenty of cash around, and bankers were keen to lend as much as they possibly can. They had to originate the volume, and so that you had a portfolio that was growing, and the earnings trigger, because of interest rates were much lower. You had to have something bigger to to kick up the same net interest margin. So you had to lend more vigorously. So a lot of that was done on what I suppose borrowers saw as more ambitious plans to grow, to expand, to acquire. Well, COVID came along and put the brakes onto it, but everyone was in a mood to kick the cans down the road a little bit. We came out of COVID, and no sooner do we sort of like come out and go, we're over that. Then we get smacked in the face by interest rates, supply chain issues, the troubles in Ukraine. So no one's really had a time to breathe. So it's been very, very difficult. And what you're also going to see, and maybe we can get onto this later, is a lot of the scoring models that the credit officer would use on a transactional basis. Now you're scratching your head and thinking, are they fit for purpose? Because they were birthed in a rather sound and predictable economic environment. Because you have to, with any credit score, for those who don't know, you have to get a bunch of what they call stratified samples. You have to get a few thousand accounts with all of your risk indicators, your income statement, your balance sheet, and you have to have a batch of those. And you also within that have to have a batch of what they call goods and bads. And then you put those through a model, and then you think, right, how accurate is this model to predict the goods and the bads? And you also have a gestation period of sometimes up to 12 to 18 months. That was fine because over the last decade, and the big agencies like Dun & Bradstreet, Experian, Equifax, and Moody's, they had all built their credit models on that, on a roughly a decade of fairly low interest rates and no real economic shocks. So now when a credit manager is seeing Experian throw up, something like 75 out of 100 and a credit limit of 250, you're scratching your head and you're thinking, is that really what I should look at pitching forward?
You see, call me manipulator, but these 15 minutes was just about this moment. Because you see, during the COVID, I've heard voices like financial statements analysis is obsolete. Credit models are obsolete. And I was thinking about that quite differently. That's why, by the way, we got this topic today.
Yeah.
But at the same time, let me ask you, and let me ask the audience, ladies and gentlemen, I forgot to mention because I was really impressed with him and having such a guest today. So all the guilty side is going to the guest. I could not be guilty on anything. So I could not be blamed for anything, which is actually not. I am responsible for everything. But again, I'm sitting here and manipulating. Main moment to discuss that is, I've heard the voices like, everything we used to do is obsolete. But at the same time, may I ask the question, can we judge to any reasonable extent about the financial health of a company without its financial statement at all? So what I'm trying to say, okay, I understand that financial statements of customer yesterday does not really give us that level of comfort we used to have over the last 10 years.
Yeah.
But is that enough to say that, okay, can we simply say financial statements are obsolete? Because if we say that, we need to say, okay, there is something better, or there is something more reliable, or at least similarly reliable. So can we simply throw away financial statements and judge on creditworthiness of a counterpart on something else, which would be something better or something more reliable? That's a tricky question, and I would like you to say a couple of words, because you see, by contrast with me, you are the one who is sitting in the office and you are taking credit decisions or recommend them, which means that you are putting your name, not had, but putting your name, putting your professional reputation, years of experience, everything against that recommendation. So if financial statements are obsolete, is there something better which we could use?
I would say no. I don't think financial statements are obsolete, but what I think we've got in an age where there is far more information out there. The credit folks that are listening in and to the wider profession have to get used to, I suppose, more embedding more qualitative entities. Now, let's just take your particular scenario, and you're talking about you have an application where there is no financial information at all. And I see this with, let's say, US companies. US tends to have one or two. You've either got everything because they have to file with the SEC, so you have your 10Ks, your 10Qs, they're listed companies, or you have absolutely nothing. So you have one of the two. So in that particular case, you do have to, if you like, play detective and form a cumulative case. So the sort of things I look at, I try to get a scale of the business, the size of it. So usually go to the customer. So if I was looking at that where I had no information, a US company where I had to make a decision and no real financial customer, I go to their website and let's say, what's their footprint look like? So lending to a company that's got 50 employees is a different proposition to lending to a company that's got 5,000. It's different if they've got, let's say, two offices, one in Houston, one in San Antonio, versus they've got offices all around the world. And you see that sort of, matrix style graphics map with, pulsating locations of the throughout the world. So you need to get an idea of scale, go to their about page, find out about it. Number two, find out what sort of industry. Now, the two things actually before anyone I've trained, I've said, before you even look at a set of accounts, there are two questions you need to ask yourself. Number one, what does this company do? And number two, who owns them? Those are two important questions.
What is the second one, if you can? Who
owns them?
Who owns them? Okay.
Who owns them? Who owns them? And it is as you can probably appreciate, being owned by a company that is ultimately held under a private equity fund is a different proposition to a company that's listed on a stock exchange, is a different proposition to what you see in a lot of Germanic countries, where you see 3 or 4 generations of family held businesses. So if you get an idea of who owns them, you can say what sort of control that they have. Number two, finding out what they do is also very important. If you don't have financials, but they're an engineering firm, and you look at their, let's say, accreditations, you can see how many ISOs they have. So ISO 9001, ISO 14001, 22001, all this sort of thing. And are they members of, let's say, if it's an engineering firm, are they members of various bodies? Because what you've got to think is that they don't want somebody to tarnish or sully their reputation. So in one sense, even if you don't know what's going on, they've had to disclose to a body that's better. Now, this becomes even more comforting if you're looking to a company that's under any sort of prudential or financial supervision. So if there is in the UK, if there's an FCA number, even if you don't necessarily get the financials, which you can, but even if you can't see, let's say, financials, you get to see, let's say, Pillar 3 statements. And you've got the fact that they are supervised by a government entity, and I work for a government, I work for a regulated entity, and the level of compliance and cross-checking is phenomenal. So much so that Dell Bank International, DAC, which is Dell Financial Services, regulated by the Central Bank of Ireland out of Dublin. they issued some bonds, and the grading of the bond was, I think, a Baa3, but at the time, Dell's grading was Ba1. It was one lower. So the financial subsidiary had a stronger credit rating than its actual parent company. And I think another example of that is Renault. I recently reviewed Renault. Their in-house finance company, Mobilize, or RCI Bank as it's called, has a much stronger credit rating than Renault itself. So, and that is because of the regulatory oversight given by the financial regulators in France and Germany and the UK and so forth. So there's that. You get onto, let's say, so, but even if you don't have that, you get on, let's say, things like solicitors and accounting firms. You go to, let's say, your local solicitors registrar, and you can actually see that firm is practiced to license. It should have the number of partners involved. And again, sometimes it's a national register, sometimes it's a regional register, like in France or Germany, for example. But you can actually think, right, these guys can't earn money. These solicitor firm cannot earn money unless they are registered solicitors. So you look at that, for example, and you can say, right, qualitatively, I'm looking at a firm. They're not going to share me their financials, but I'm going to look at a firm, and they are, there's 300 licensed solicitors, or 200 licensed accountants, or 50 accredited engineers. And part of that accreditation is that they have to have what's known as reasonable oversight of the financial affairs of the firm. So those are issues you can also look at. If you're looking at, let's say, a manufacturer or a distributor of equipment, like necessarily what I would have in, let's say, Dell, you look at what I call the metal. This is going to, so what I mean by that is that you would say they're a Cisco Gold partner, a Microsoft Gold partner, a Dell Titanium partner. They're all rated by precious metals. Don't know why, but that's the thing.
No, this I understand, but again, you see, this is clear. We have lots of sources to compare company and the company. Yeah. And then, okay, I got similar understanding of that, but I try to be more dramatic because we are exchanging ideas. Once I was speaking with the CFO of a company which is working on one of the markets in Eastern Europe.
Yes.
Said, what's your assessment of the credit worthiness? And the answer was quite interesting. I got portfolio of receivables. And my customers change the legal entity. And this is building market. This is construction market.
Okay.
Our customers change the legal entity in about 10 months, in about 11 months, but surely less than a year.
Yeah.
So every year they change. So what can we speak about their credit worthiness? I said, so how do you assess your portfolio? And then actually, this is the classical example which I'm now sharing in my course. Simply recognize that what's the reason of looking at financials? Because they will never produce them. They open a company for 11 months and then they do project and they close it and then they go ahead. Due to certain reasons, there is business reason behind it. It's not like they want to do that. But what is interesting, like how can you operate in that? And what I found is quite interesting. You just recognize that credit worthiness of all your customers is 0.
Right. Wow.
I mean, how else can you say? Obviously, there will be some people who pay earlier, some who pay on time, those who might pay a bit late. But what is the reliable attitude you as a financial or as a credit manager can offer to your colleagues and to your top management, to the owners of your business? Merely say, our receivables are money we should be prepared to lose every given day. And if we are not in comfort with that level of credit risk, the only thing we could do is to turn back and leave this business to our competitors. Because my view on that is, okay, there might be some, say, signs of comfort which are giving us a positive signs of positive attitude, positive willingness to pay.
Yes.
Or like reputational risk if they don't pay, especially in Western Europe, especially in States and something like that. But the question is, again, if financial statements are obsolete, how can we judge on customers' credit worthiness? Simply, if we don't know if they make profits or not, if we don't know if they are zombie or not, if we don't know if they're technical bankrupt or not, I do agree that the bigger company is but in potential, is much more credit worthy than a company of 3 people.
Yes.
But at the same time, we never know if they are making, with everything what I just said, can we reliably judge? And I'm very far from that idea. And again, you see, I will throw in a couple of things which I wrote about, over like just ideas. When we calculate financial ratios, we learn in the book, Credit Management Handbook, somebody was studying economics, somebody was studying accounting, and everything that, current assets by current liabilities give us a liquidity ratio, current ratio.
Yeah.
Then a question, and then somebody says that this current ratio must be above 2. We may speak for the rest of our days why it is 2, not 2.1, and is it better or worse if the ratio is 1.9? But then it's a question, we still think and we still deal with an exact number.
Yes.
The constant number. But at the same time, everyone understands that every single number we take for calculation of ratios is not a constant, is a distribution.
Yes.
Best case, it is bell curve, because we know that current assets never stay as they are at the end of the year.
No.
And then, when we speak about credit models, it's even more interesting. Because when we say, okay, we know that models are based on sets of financials and sets of data, historical data.
Right.
Which means that's we use an example of liquidity ratio. We know that it is never 2, or it is never 1.9, or it is like even historically it's trending, but in reality, it changes every single day like this. Like electricity in our house, we believe it is simply give us 127 or 220. But at the same time, we know that it is minus 50 and then plus 50, somewhere in the mid. Whatever numbers, I'm not very good at that engineering, but somewhere in the middle, we've got 50 amperes and we've got 220 volt, which is meaning that somewhere in the middle it is like this.
Right.
What I'm reading you see, we used to look in when we assess credit risk with all that models. We believe, we understand that somewhere between, let's say, 1 and 0, there is a value of the ratio we calculate and the credit worthiness we calculate.
Yes.
But how can we, let's say we use data which were between 0 and 1.
Right.
And they are in past. And then we're supposed to take a decision about the future. But how can we guarantee that the value we are assessing in the future will be between 0 and 1, or between A and B? And what if it goes beyond that?
Okay, so you're talking about the constituent members of a credit scoring model, and you're talking about.
I'm just trying to say, okay, I mean, what I'm trying to say, we could never guarantee that in terms of credit risk, the future is defined by the past. I was very uncomfortable always. I mean, I could not say credit models are useless. I never said that.
Right.
Yeah. But what I was trying to say is we build a model on set of data, which, like, I mean, I use like X is between 1 and 0.
Yes.
But how can we be sure that in the future it would never be minus 0.5 or plus 1.5? Beyond there, how can we guarantee that that X, which we call credit worthiness mathematically, will always stay within this matter? Because that's the main idea the model is built on.
Yes.
Because set of data like restricts its possible value. And then we go ahead. I mean, people might think now, and you might think that, okay, what this guy is speaking about mathematics, which he doesn't know. I'm not very good at mathematics and statistics, just a bit of logic. But what I can tell you, I used to have a customer absolutely closer to the end. So about 20 minutes, there will be a chance to ask questions. Sorry, and to make sure we don't forget them, ladies and gentlemen, please type them in the chat.
Yes. Just
and Brad is great in answering questions. I don't know if there is something in the world I love as much as questions. Well, yes, if you wish, I can add the script of chat, because Zoom provides that.
Yeah.
There will be questions, not answers. But anyway, normally I repeat them in the voice, so you will not lose them in the record. Coming back to that, we were speaking about recovery rates, if you wish.
Yes.
Because, I mean, more practical, not about that, what at that X, which is abstract. Okay, let's take a practical example. I used to have a customer, and every single year, over 5 years, I was calculating their Z score, and I was calculating the financial, using their financial statements, I was assessing their credit worthiness.
Right.
I still dream that one day in that area there will be Mr. Altman, because I was calculating that score, and I know what he would say about that. It's not about this, but I don't say, and I'm not blaming that score that it is correct or incorrect. But what I'm trying to, because I read the book, but I not learned the Z score from Wikipedia, as it normally people do now, but according to the Z score, every year the result was like they're supposed to go bust over the next year.
Yes.
Like it was something very, very close to 1 or below 1.2. I don't remember the details, but it was very low. It was red zone.
Right.
5 years, this customer was paying me an amount of several tens, couple of dozens of millions of euros with no delay.
Right.
And then, okay, this is positive example. And somebody might say, okay, there might be a day when they will stop. But the question, should I leave this customer, or should I say goodbye to this customer just because there's its score is?
Yeah. So in one sense, I think that's it's one of those strategic exercises where you want to look back on all your declines and think, did we do the right thing? So that's an exercise if you've got the manpower and the data to do it, and it's very revealing.
Mhm.
But even if you look at, let's say, those at the lower echelons of your Moody's scale, let's say your S&P scale, you're down to your B minuses, your and so forth, B3s, you're looking at a default rate of, let's say, 1 in 10. So that means you're still going 1 in 10 or maybe 1 in 15. Sorry, 1 in 10 or sorry, go the other way around, about 1 in 6. So it could be anything from those sort of odds.
Mhm.
Um, you will still have five, or you still might strike upon that 1 in 6, that 5 in 6 that will pay you. It's just if one goes bad, there was a high probability of it going bad. And given the fact that most credit works on fairly thin margins, you would need to successfully write business of another 20 or 25 to compensate for your loss. So you will eventually, you may get paid. In terms of your earlier question, and in terms of what do you do with, let's say, financial ratios, I think what we have to start doing is getting our hands on data or engagement with data bureaus that have, let's say, pools of far more real-time information. In the US, they are very good at this because they don't have the private companies don't have financial
Yes.
information, so they are based on trade data. And I think if you are in a bureau that can give a reliable trade data experience,
May I interrupt you just for a sec? When you say a trade data, because we are discussing data.
mhm.
So when you say they provide the trade data, what literally you understand under the trade data?
Oh, okay. So what that would be is that you would have a ledger, let's say your accounts receivable ledger, and you would identify it with the company number. So, whatever it is, a company number, or even, I don't know, a DUNS number, if you like.
Yeah.
And what you would do is submit that on a monthly basis to the credit bureau. And that ledger shows all the companies paying their invoices 30, 60, 90 days past you or what have you. And they pool all that trade data together, and they
Okay.
give you effectively monthly repayment scores or monthly delinquencies that they
Clear.
have gathered
Yeah.
from there. And it could be you don't get access to the data, you have to contribute to get access.
Yeah. So this is like I know that's like they are exchanging. You see, again, it's not like I'm skeptical.
Mhm.
Having something is better than having nothing,
Yes.
like financial statement analysis. But one of the things, each time I look at that trade data and look at the payment scores by, credit bureaus,
Mhm.
I just simply look like, okay, they share like invoices for, I don't know, like 1 million or $10,000 for the payment score of the Mercedes subsidiary, which has a turnover of, I don't know, hundreds of millions.
Yeah.
And once again, you see the problem with this data. And another one is that obviously overdue is very informative. But I know, and all the credit pros and all the people involved in credit who listening to us really understand that judging on overdue without knowing the background
Mm.
is, I mean, it is like, is less informative, because when we start to slice dice, we understand that, okay, good part of that could be disputes.
Mhm.
This is not really an overdue. So, okay, when we put like judgment, okay, we want somebody to pay on time with everyone. And again, coming back to the payment history and to the credit history.
Yes.
So you see, next time I will ask you to wear a white shirt, and I will continue to be in black, so I will be a devil. Then it's a question, example which changed everything in my head. was like when one colleague shared with me an experience with a German company who used to pay on time till the date they declared bankruptcy.
Yeah.
Every single payment was coming on time the next day. They said, sorry, we are declaring bankruptcy, but you were paid. You just paid yesterday. I said, yes, we did our best as long as we were able to. But now we can't, therefore we declare bankruptcy. The same story, I was interesting. I was speaking with a real economist, very knowledgeable, and he said, "Okay, look at what he gave me. Okay, rating is good, but if you look at the country rating of Greece, how it was falling down in 2008, it was just like this, and there was no too many signs of that. Okay, there may be signs on the background, but not in rating. You see, what I'm trying to say, and one of the ideas, and my question would be, we look and we have lots of data around us.
Yes.
But surprisingly, and we try to do that. And we try to use all of them. And I'm pretty sure we're supposed to. But what is interesting, in the end of the day, we all deal with the same or extended version of the credit report done and breasted, created in the century before last. In 19th century, they started to do that.
Yes.
And we still deal with that. Okay, it is electronic version. We add something, but you see, the question, is that enough? Is there something more? And other questions, I got quite wide version. Do we use the data we have, even with credit report? Because credit report is just like pulling in maximum of data so we can adjust them. And this is great job done by credit reference agencies and by the credit bureaus. I do agree with that. But the question, do we use it in a proper way and to as much extent as we can?
I think I think it's not just the action. Yeah, using the data, I think it's a good idea. It should only be as a. Okay, I'm back. It should only be really as a guideline, in one sense, but you should be looking at, I suppose, more short-term longer-term trends. So what is the behavior of this company? Well, it tends to pay a bit late. Well, then you can kind of factor that in. Another good source of this, coming more and more to the fore, are credit insurers. Some of them are now starting to offer their services as purely a limit advisory. And the interesting point about that is that when you take out credit insurance, and if you become aware of anything that's adverse, you have to advise the credit insurer of the, you might think, well, hang on a second, they've not paid, or we've come to we've found some adverse information, or you have to report that in. Now, that doesn't get reported out wider, but what it does start refining and maybe adjusting the level of credit insurance available to that company. And a lot of credit insurance companies will then sell that on as sort of like an advisory and saying, well, now we used to insure to a limit of, let's say, 500,000, but we've heard some adverse structural information takes it down to 200. And that happens month on month. And if you take credit insurance, if you don't inform them, and it compromises your cover. So you've got to insure them. Otherwise, if you go to claim, you don't get a cover. So, but
yeah, because you see, the thing is, the conclusion I came, because we already close. One of the thing is all the data we use for credit decisions I used to exist before. Now they are digitized and we got more access to them, and we're supposed to use them. But what is interesting is that in nature, the data didn't change. In nature, nothing is replacing the knowledge of a credit manager or a creditor, the business of the obligor, of the debtor, of a client. I prefer the word client. So you see, the idea is like, I believe the time we are passing through simply highlights and bringing us to the idea like, ladies and gentlemen, you might continue to believe that big number of data, or like say volumes of data, or availability of data, or instant availability data of a data will release you from taking credit decisions in the situation where you don't understand everything. And this is the pain, but this is the pain credit professionals supposed to pass through. You never know the future. Please accept that. You could not know the future. You cannot calculate it. You cannot, whatever model says, the future might be different.
Sorry, I'm on mute.
Yeah.
So yeah, I think so. It could be different, but you are taking a calculated risk. Without risk, you're not entitled to any reward. So you do have to take some risk as long as you're being compensated for it. Should we answer questions, you think? Because
we'll answer them in about 8 minutes.
Okay. But yes, so in terms of the you do have to benchmark it on something, and whether that metric is financials that are available, and that depends on your economic environment. Here in the UK, we're spoiled. We have a lot more, but I know, let's say, if you're in Switzerland, all of the James Bond troops are quite true, where you don't get any information out of anybody. So you have to work within the constraints of the environment. It may be that your credit decisions weight more upon the experience that you get from credit bureaus and credit insurers than you might get from financial institutions. But if you can glean things to augment on top of that, such as the size of the company, what clients they have, what do they do? So if they, let's say, high-end cybersecurity software for public enterprise, for public sector, you don't get to enter that field. There is a natural barrier to entry. So you've got to make sure that you've got the background behind that, and you've got the financial backing, because a government entity, for example, or a hospital, they're not going to engage with you unless you're going to be around for 3 or 4 years. They're not going to sign a 3 or 4 year contract with you unless you can show 3 or 4 years worth of financial robust resources.
Yeah, I agree with you.
Yeah,
I agree with you, because I think, I was right. I was just decided to write about that because I think the best advice on credit management I've heard in my life was said by Joe Pimbley.
Yes.
I think I've shared that with you already, and I'll share that publicly, because success of credit management is not correlating with the perfectness of credit models and qualification of credit analysts or somebody. That just only correlates with understanding of customers' business, and this is irreplaceable. And this means that you take all these little pieces of information you're feeling. Because, people cannot, might not believe it, but share with me one thing. When you see a person, when you meet a customer, in 10 seconds or in 15 seconds, you understand if this customer is reliable or not. And then you just double check in your feeling.
Right.
Is that correct?
No. I tend to I take them at their word, but then I'm a very skeptical and doubtful person. So I tend to also back it up with something, because I think in 8 months' time, I've forgotten what I've said about them, what I've met about them, what's on record. And anyone should be able to pick up my file and say, what was this fool thinking when he underwrote this amount of money? And it should be fairly clear.
No, but what I'm trying to say, no, it's not like a question. It's not like a question you already decided.
Mm-hmm.
Yeah. And it is not like a question you can put your good feeling into a file or shoot or put that decision on you. No, never.
Yeah.
But, meeting somebody in person gives much more understanding of what they do.
Yes.
And understanding of their business, how they present, the way they present is much more important. So the thing is, again, I came to a conclusion that there are lots of things we can do.
Yes.
And one of them was recent case which happened to me, in my practice in UK. I think I shared one with you just like to highlight that. It's not like, the company was using a famous fintech, which was connected to the company house. And they sent an advance payment to a supplier. I was helping them to get that money back.
Okay.
And in that fintech database, in that connection, the company was like, it was like normal, it was like an active company. But actually what my client did, they signed a contract, they sent an advance payment to a company which was already dissolved at the moment of signing the contract.
Mm-hmm.
So it was really complete fraud.
Right.
Quick fraud. The question is, you see, instant availability, obviously, they can simply go to the company house, but at the same time, using that simple example, not about the fraud, obviously, my client was like, or the only person they can blame are themselves. You have to check, that's elementary. But the thing is, how can we work with the customer knowing that on the background they can be dissolved or closed or change the registration? This is where these online services are really irreplaceable.
Yeah.
Monitoring, providing data, updating what we do. And this is, I do believe, we are in much more comfortable situation than our colleagues 50 years before.
Absolutely. Absolutely, yes. I think we're not taking advantage of the diverse range of data that's out there, more fool us, because really the data is the oil in your engine.
Absolutely agree. Absolutely agree. Looking at you, I understand you would like, we are, okay, let's move to questions.
Please, yes.
So we've got some comments like in the company we built risk models. If there is a chance to ask questions, yes, absolutely. Paolo, as I promised. So we've got comment. And then there is a question. I have found credit bureau information is helpful to identify exposure, not profile potential default. Nisha, my attitude, I will ask Brad to answer, by my attitude to that can be highlighted by a simple fact that credit report contains 5 pages of information and then 15 pages of disclaimer. I think I believe I got the same feeling as you. Credit bureau provides you with information, but they cannot give you I don't know, take decisions to take decision on you or instead of you. What do you think, Brad?
Yeah, I think the idea that credit bureaus definitely there should you should be relying on the first point of getting to credit bureau information is getting the information yourself. Um,
Yes.
Whether or not I pay less if I do see something that points to a fault, like let's say a credit score that's fallen off a cliff edge, I'm asking what drove that. In a lot of cases in the UK, what drove a huge drop in credit scores, let's say Experian, they go from 100 down to zero, was the fact they were 1 month late filing their confirmation statement or their accounts.
No.
So unless you understand what the bureau's model is, then really just Nisha, just rely on the information, and you have to look at your own I suppose your own credit eyes to make sure that you're not missing a point. But certainly there's value in the information.
Yeah, I mean, credit report, as I said, in the closest analogy is that they are doing good job pulling in information and put it on our table in the prepared, structured way. This is their responsibility. But in terms of analysis, we may discuss later on, but we still got question. Okay, the question from Alina. From what threshold on would you do financial statements review? Do you use any automated data besides ERP transactions and DNB reports? Mr. Morris?
Okay, so certainly in the UK, if you don't even open up a set of accounts from if you don't even look at the basics and make some sort of commentary, I think you're a bit of a fool. In the UK, it's fairly free. But if you want to do a full threshold, it depends on your level of investment in your portfolio. So for you, Elena, 100,000 might be what's required. But what you also have to think of is that what are the salient points? If you are spending a day, or let's say six to 8 business hours doing a credit report, you have to work out your own cost measures. Example really is that you probably want to do a full credit report if you've got an exposure over about $1 million, euros, pounds, sort of thing. That tends to be a magic number in a lot of financial institutions. If you go, let's say, down to about under £250,000, again, you're going to have to scale this for your customer, because Dell Financial Services latest reported portfolio was into the billions, into a few billions. So if you've only got a few million of outstanding receivables, it might only be your top 5 customers that need that. But yeah, over $1 million, I think in most cases you should be doing a full financial analysis. That may take you, let's say, 3 or 4 hours, depending on the automation of data you've got behind it. Up to, let's say, between 250 and $1 million, you should be able to put that on one page of data, about the customer, financial and recommendation with maybe a credit grade. Under 250, certainly under 100, again, scale it to your portfolio, but really just a few bullet points, because if the thing falls over, you've got to go back and say, what was that decision based upon? So really design it from that point. If this 100 fell over, how many bullet points do I need to say I did my due diligence?
Because I mean, Alina said that it was the question from for Brett. So if Brett allows me to add a couple of words, I think it's a question how much money your company makes on the transaction.
Yes.
Because the turnover and outstanding receivables could be high, but like if we take an example of oil business, they make that the margin is below 1%, like in trading business. And then it's a question whether or not financial analysis or credit analysis add something to the decision. Yeah, but we better go for bank guarantee immediately without any credit analysis. Another thing is, my favorite example is quite what is called hidden champion here in Geneva. It's quite well-known company, but they shared that information confidentially with me. So being gentleman, I would not name the company, but they got 500,000 customers around the globe, and the usual transaction is between $2,000 and $10,000. $10,000 is quite high. So even if they just buy credit reports for all of that, they will not have any profit. So it's like, imagine $50 per report. So this will be, unreasonable.
Yeah.
But at the same time, again, but another point, another food for thought. And before I even say that, I would say that every credit function is individual.
Yes.
Every single one. And then what I'm trying to say on the other side of that is like time your people spend to do credit analysis. And when we speak about automation, I always provide an example. Like, we had a customer who we knew they're technical bankrupt. We knew why. We know they don't have money. We were like, it was like, I don't know if we say that it's already not a zombie, but not yet bankrupt. That they were living on that age of technical bankruptcy for years, just because suppliers didn't want. They were like kind of too big to fail. And what is interesting, when I came to visit the market, they showed me a report from Credit Reference Agency. Obviously, Credit Reference Agency doing their analysis automatically. And the report was saying credit worthiness 100 out of 100, like AAA. You see, automation is not like kind of protection. Again, if you, answering, because I'm working with that, Alina, and what I'm trying to say is that there should be kind of reasonable added value from that credit analysis. Because, if you got 100,000 customers and you work alone, there is no way you do that. Because there are other job to do. One of the suggestions, again, a lot will depend on either you are in inclusive or exclusive credit, whether or not you are allowed to say no based on your calculations, or you just go ahead because you are an inclusive credit. So what's the value of that credit analysis? So lots of factors to be taken into account when you do that. It's not like, automated analysis and scoring. That was exactly what we discussed with Brad today. Can we just calculate reliable credit worthiness?
Yeah.
Could it be just calculated? And I'm very, very far from that idea, because there must be also judgment. And by the way, my favorite saying, credit analyst is not the one who is calculating. Credit analyst is the one who is writing.
Yes.
Because real job of a credit analyst is take all the data, analyze them, and finally write a conclusion. Yeah, that's that.
Or as I say, tell a story about the numbers.
Yeah, absolutely. Nilesh is asking, how do you identify the optimum because of the pressure on cost to serve? Yes, you have to, Alina, just finishing with that. You cannot, you will never have enormous resources to analyze credit. But then you with your management supposed to, to decide what is reliable. Now, what is enough? Because like you cannot have I don't know, university and institute or scientists doing your credit models. No, you have to take decisions. And this is decision making in credit is unavoidable. All the rest you cannot do, but you have to decide.
Exactly.
Nilesh, coming back to your question, because what he said directly, but I have to read it. I believe there is nothing confidential in that. How do you identify the optimum interest rates? Brad, it will be to you, and down payments for a given Vantage score customer to derive their post-treatment profit probability of default from their intrinsic probability of default. I could say only I am sorry. Mr. Morris, the floor is yours.
Oh, okay. I'm just making sure I'm answering the right question. In any of this, what you have to work out is the cost of default, and that is only something that's intrinsic in your own portfolio. So it's how much level of default you can expense versus the amount of net interest margin you're going to make. So
okay, now it's clear for me. Thank you.
Yeah. So yeah, it's the idea of, let's say if you had, I don't know, a 2% bad default rate, a write-off ratio, you've got to think, right, what's the cost of my 2% write-off versus the earnings of all the good that we come in. This is your credit scoring fundamentals. So I mean, if you can get away with charging 10-15% interest rates, then you can be far more liberal with the sort of credit appetite that you've got. But what you then end up doing is getting into a battle with your better credit quality customers and saying, why am I paying 10-15%? I only pay 50 basis points because I just got rated AAA by Moody's. So you do have to find that sweet spot. And if the best thing to do is to try to find the sub-investment grades. So this would be the things, let's say a B, sort of like the double B plus, because there you don't have the elasticity of pricing that you do with, let's say, the higher credit grades. But when you get down to just doing the lower credit grades, that's when let's say, doing distressed debt or, you're almost the payday loan territory. So you've also got to put that in context with your market.
But Brett, is that still about what we call exclusive credit? So where you are allowed to choose customers. So I understood from your words, is that this is about the pricing of a loan. So how much pricing we could have. But the question is, that's still about the exclusive credit where, I mean, if we don't sell to this customer, there are two others who would be happy to come and buy.
Yeah.
Because that's the point of Nilesh, you are allowed to reach to me and I will transfer further questions to Brad, or you can find Brad. He's quite responsive on everything, but we can continue the discussion because that's pretty banking. And again, you see, I found that there is clear division. Sorry, I mean, he just copied the same question openly.
Okay.
Publicly. The thing is, you see, on one side, it's about ideas. On one side, we know that the receivable is not a loan. There are lots of signs which really distinguishing receivable from a loan.
Yeah.
And this, like, we cannot, honestly, we cannot always use the method used in financial services for receivables for the real market.
Yeah.
I mean, not all of them will work. I came to a production company from the bank, and I had to learn alone because that was absolutely different world. Although I believed it is. It was the same. There are lots of people who still believe it is the same, but it is not. But what is I thought that the main difference between the two is that that financial services, regulations, formulas, calculation, everything. But what I came to conclusion too is that no, the main distinction is not like the loan has interest and receivable not.
Mm-hmm.
The main difference is that most part of real sector companies are in inclusive credit situation where they use credit to attract customers.
Yes.
And in financial services, it's mostly exclusive credit, so they can say no to reasonably big number of customers without real impact on their business. They are choosing customer, therefore their credit is exclusive.
Yes.
This is the main difference. The same story, by the way, when we compare receivable to an investment.
Yeah.
Investor is allowed to say no. Bank is allowed to say no to a customer in much more bigger number of cases where the credit manager of a production company, of a manufacturer, I don't like the credit worthiness of this customer, so what? Should we cut half a portfolio to have what? Yeah, this okay. I mean, like coming back to the example I shared with you in the beginning. If you don't like credit worthiness of this customer in a construction market who are changing their legal entity every 10 months, you can simply go elsewhere on another market and do business elsewhere, but not here.
That's right. That's right. Yes. You have to, that's why the question was, who owns them, what do they do? If you are in a market where you have short-term incorporations, special purpose vehicles that are set up purely to process invoices, and they're backed off by usually a larger construction consortium, you have to understand that market. Just simply entering it without saying, right, is there a specialist bureau that can give me more information than, let's say, the regular ones? Otherwise, you're just going to go in and you may as well put your finger up your nose, because you'll get just as good as a result on your credit scoring.
And in the end of the day, this is interesting topic, because you see, in the end of the day, customers either pay or not.
Yeah.
That's one side of the story. Another side of the story is, you see, when we speak about that inclusive credit situation, which is at least half of that.
Yes.
And this is about the Nilesh, if I pronounce your name correctly, please correct me if I'm wrong. What was said in the question? Like how much credit risk we can take, provided the losses we take, and so on. But imagine the situation could be dramatically different.
Yes.
It's just like when you enter a market, then it's not a question how much credit risk you can afford. The question is how much credit risk you have to take if you wish that level of sales.
That's right.
And so risk taking is not like a question of your choice. The question of your choice, absolutely correct. No, the people who take decision, or if you are a business, or if you are a businessman, if you are heading the company, the question is, do you understand the risk of your portfolio correctly?
That's right.
Because that's really a story behind that. You see, the question whether or not board understand the risk of receivables portfolio But the problem is when you enter the market, you understand that, like you have no financials. You're supposed to give 10 customers a credit limit of 10 millions each, and you have no idea about their credit worthiness. Then you're supposed to be ready, and your management's supposed to understand what they do, what they decide about. Is that we're supposed to be ready to lose these $10 million every given day.
Yes.
Any given day. And okay, we might go for security, we might go for bank guarantees, but if customers will refuse, again, we simply go elsewhere, but not into this market. Well, the question is like risk avoidance or just choosing the risk we're supposed to take might be not be as comfortable as in some industries where like we refuse one customer, two others are coming. But at the same time, there might be, industries are different. Those invoices, payment behavior, and can be monitored as banks do. Suppliers experience score. Okay, I mean, and Nilesh, and I think Brett's point around this is stress test. Elasticity makes sense. So if someone has an intrinsic default probability of 10% by increasing the interest rate from 2% to 3% based on elasticity, I can drive the default probability down to, let's say, 8%, all made up numbers.
I think, Nilesh, good thinking, but what I see you're doing is conflating the risk and the earnings. You may it's probably close to maybe driving a Basel II model there or something of that nature. But if what you're saying is you can take the risk, what you got to ask there is, are you taking the risk out of the customer or are you taking the risk out of your transaction? They are two different questions. The risk of the customer will not be impacted by let's say whatever interest rate you place on there. What you are doing at a transaction, because that stands independent of that. If you had, let's say, 20 institutions, let's say they all use, I don't know, Dun & Bradstreet or Moody's risk calc models, they would all end up with the same risk profile of that company. However, what you're doing is taking it out of the transaction. It's a valid approach, but just make sure when you're looking at it, you can say, right, I've got the risk of the customer here, which is effectively independent of what I do at a transaction level, and you manipulating interest rates, which is the right thing to do because you're taking on more risk. You should be what you got there is risk-based pricing. So at a transactional level, you're doing the right thing.
I agree. I agree with that, and I would say that you see, once, okay, maybe I will give a more simplistic example, but speaking with one senior person, it's to the contrast what Alina was saying today. I found a ton of sense. I mean, whole bunch of sense, trust me. Thank you, Brett. No, well, what I was trying to say, finally, thanks to Brett, because he had to translate that to me. You see, and I will give an example. Obviously, higher risk supposed to bring higher yield. That's okay, but one of the things that for trade risk, for trade credit managers, if you wish, but at the same time, there is that wide question whether or not credit worthiness of a customer supposed to be affected by their importance. Give you a practical example. I'm speaking with the head of treasury of quite big company. Say, we would like to have a credit analyst who will be analyzing accounts. And like assign them through the deeper analysis, assign to maybe to some of our customers, the rating can be higher so we can afford more credit.
Mm-hmm.
Maybe I misunderstood him, but there are, he said, if our customers are C, maybe they can become, double B. But the question is, can we drive creditworthiness of a customer by customer's importance? I'm not sure about that.
Importance to who?
To a business.
Importance to who? Okay, then fine. I think you have to start getting insular. The credit risk of the customer is independent upon your engagement with them. Okay.
Absolutely.
Yeah, that's right.
Thank you for that translation from my Globish.
Yeah, that's exactly right. Just because you engage, let's say you're a larger corporate, just because you engage with a customer that, let's say, got a Standard & Poor's rating of double B, your engagement doesn't make them a double B plus. It never will. Okay.
Yeah.
No. So what you have to do is saying, right, I've got this customer, this is their credit rating. And what you might do is what I do when I'm going through transactions is I'll benchmark it against the financial ratios. You'll put those in and you make commentary on the financial ratios. So they're the usual favorites: liquidity, the profitability, the debt service, the sales growth, the asset quality of your debtors, all that sort of fun games. By the way, they're all different across the different kind of geographies, but you put that in place and you come up with a benchmark, and then you will say things like, you'll have the qualitative things such as these customers, we've spoken to them, they have recurring revenue on a 3-year basis because of their software licenses, or because they have a steady revenue stream from because of the stickiness, trying to get out of them, the cost of replacing suppliers. So you layer on the qualitative factors. They've got a regulatory oversight, and then you come up with a credit rating in your own in-house credit rating. Then from that, you can say, how much risk do I want to take on this entity? I've qualified the risk. I've benchmarked it. It's tested. I know what that is. Now, because of their importance, do I wish to sit in a credit limit of 2 million, 5 million, 20 million, whatever it is that you're using?
Yeah.
And in doing that, you think, right, I'm taking this risk, therefore I'm entitled to a reward. Now, what you may have to do is think, where am I going to get that risk-based margin from? Am I going to discount that from the cost price of my goods, which is going to have a far bigger impact upon your cost of credit? Or am I going to simply layer that in and spread it over terms? Are you going to have what they used to call blind discounts, internal subsidies, that sort of thing? So you're going to have to all weigh that together before you're making a difference. And probably the best way to do that is to get the old-fashioned heat map and say, right, what's my exposure on one axis and what's my risk on the other? And it's where you have high risk, high exposures. Those are the things that you've got to be monitoring, and you've got to have almost a real-time, but at least a robust suite of reporting that will filter into an analyst to say, yeah, that particular customer over there that used to be a double B plus, they've recently got taken over by a private equity fund, and they've dropped down to a B minus. By the way, little experiment for all you credit geeks that are really in there. Just go on, get a free account on Moody's or Standard & Poor's, and just do a wild card search for anything that's got Topco, Midco, Bidco, Debtco, Holdco. Those are typically the vernacular of private equity, and you watch, they're going to have extremely low credit ratings, down at your Bs and your B minuses. But you're going to see a lot of that happening because there's a lot of M&A activity happening across the world.
Yeah, and I will just add another interesting moment, just because I believe it is interesting. And one thing which makes me sad that whatever we speak about credit data, in the end of the day, discussion is coming about credit risk. But I really thank to Brad, grateful to Brad for highlighting that, because we lately, recently I did a bit of a poll on LinkedIn, and I would just ask whether creditworthiness assessment amounts to credit decision, and about 50% of the people, if not more, said yes, which is not the case. The problem is, with all due respect, is that creditworthiness assessment is one thing and credit decision is different. Creditworthiness is part of a credit decision, but not replaces it. Like, okay, we only work with the good guys and we don't work with the bad guys. Well, if you would like to choose customers, okay, if you're lucky enough, good luck, but then it's a question. But another thing, you see, with ratings, especially when we speak about non-specialists, when we go to trade credit, okay, everybody knows that rating AAA is good. But again, if all of our customers got rating something close between BBB plus and BBB minus, then what? And then it's a question, you see, when we speak about default probability, I was given that example several times. You have to, can we give this customer 100,000 credit limit? No, why? Because their default probability is 10. The question, risk becomes invisible with default probability, assuming that bond rating equivalent is a default probability to a certain extent, then okay, what it gives, we would obviously, on a portfolio of 100 customers, combination of that default probability is really a valuable and meaningful number. But then there is a customer, they either buy or not. We either earn money if we ship to them, or we don't earn money if we don't ship to them, because if we don't ship, if we don't deliver, we for sure have no profit.
Okay.
If we deliver goods, we might have a chance. We might be entitled to that profit because they will pay. But if we don't deliver, if we don't sell, we don't have any profit. Because we don't have sales. And then it's a question, like, you see, what can we do? What normal individual can do with 100,000 a default probability of 1, 2, 3, 4, 5, 10%? Multiply. Okay, 10,000 could be good again on portfolio level, but on the individual level, 10,000 of credit risk. No, it doesn't seem careful. Correct enough, because customer will either pay or not. That's why it comes to the stage the creditworthiness reflected in money. So how much money we can trust to this customer based on their financial statement, based on their financial situation. And then credit risk become really material, because if their creditworthiness is 1 million and we give them only 100,000, good, why not? But if we're supposed to give them 100,000 and their creditworthiness is only 1,000, are we ready to put under risk 99,000?
Yeah.
And it's absolutely different feeling. Coming back again to the construction market and $10 million receivables, when we say, okay, we need to be ready to lose them. Not maybe at the same time, and then we start doing really, I think one of the biggest problem of credit management is that we got too many analysts and too small number of synthesists.
Go on.
Like, who can really combine all together and come with a conclusion, even a simple way? Like, again, imagine yourself as a boss. You are a boss. Your credit analyst is coming to you. Obviously, there are a big number of things, but when there is a business out behind that, all the calculations and everything, what would be the only one question you ask your credit analyst? To my understanding, the boss wants to know how much money I can trust to this company.
Yeah.
How much? Because then I need to understand, I need to trust 1,000 and I can trust only $10 or $1. Then here is my difference. And if that understanding is higher, like I need to grant 1,000, but the credit worthiness is, I don't know, 500,000. Quite simple.
Yeah.
What would be your only one question? In your current operations?
If I can only ask one, if I only can ask one.
No, I mean, you don't, when you listen to your credit analyst, I believe you got in your team, not only one. But do you want them, a whole deck of 100 slides and 2 hours of discussion about the worthiness of that customer? I don't believe you have time for that. In 3 hours, he or she's supposed to analyze the customer.
No,
it's my personal standard. Yes, but then you suppose that, I mean, normally it's only one thing. It's only one question. But as you work in financials, in trade credit, I'm pretty sure 90% people will support it, how much money we can trust. But you are in financial services. What would be your, let's say, golden question?
To a customer, a golden question to a customer.
To a credit analyst.
Oh, if it was one, if it was one question, I'd be asking that. Okay, this is strange.
I put you in trouble. Sorry.
Yeah, that's okay. That's okay. One
I
question.
want you to play trade credit. I'm sorry about that.
You want me to do trade credit? I would be asking what terms have we given them, and what's the size of the company.
You're already on a decision side in terms of trade credit.
Yeah.
But then, because the question is, you see, when we credit, to my understanding, there is analysis and there is structuring.
Yes.
Because, okay. Sorry for putting you in difficult situation.
No, don't. No, I just got to make sure I'm answering the question.
The idea of trade, I mean, behind the trade credit, behind this everything is a bit simple. So we take credit. I do believe we do that in any type of credit. We take credit as it is. We might decide not to do, which will be not to go anywhere, just because this will be risk avoidance.
Right.
That's okay. But then question of terms is already sits not with credit analyst. That's why I put you in difficult situation. I'm sorry about that once again. But then a question, what terms we offer is already structured. It's the job of a credit manager.
Okay.
How we include that credit analyst, but we need to offer adequate terms.
Right.
And this is the question of another huge discussion with you and with maybe others. But then the question, there might be some customers we cannot offer any credit terms, any terms at all, for instance, in case of compliance.
Yeah.
But then real art of credit management or credit manager stays with structuring.
Yes.
Credit worthiness of a customer might be 0, but we might find a way to get a bank guarantee from them, or we can insure them. Okay, get bank guarantee, compensate cost, and still do business with them, although their credit worthiness is 0, and still do business with them and spend some money on the bank guarantee, compensating it to them.
Yeah.
But it is still, tiny part of our profit we make with them, and we continue to do successful business. It's just like simple example of structuring.
Yeah. So, I mean, for me, if I could just ask for, I suppose, it to be summarized in its most condensed form, I'd be asking them 3 questions. Once I get past the name, I might be able to recognize it. But how big are they? How much do you want in them? And what is the credit grade you are giving them?
Yeah.
Okay, so and really just have that. You could put that in one sentence if you like.
Yeah,
Yeah, and that at least. And here's the thing: what I say to my team: take control of the subject line of your email. How you got the courtesy copy and the blind courtesy copy. How many people change that subject line? You don't. You just forward it on to anybody you want. No, take control of that. Okay, and say exactly because look, we're not looking on PCs, we're looking on these shiny little rectangles now. So when you are, surfing your coffee in one hand, or you're out getting your artesian sandwich for lunch, and an email comes up in one line, you don't even have to ask. In one line, you can say, "Oh, I know why I'm looking at this now. You want me to make a decision, right?" And you can do that quite simply.
yeah. That's why, by the way, I just compared the writing of executive summary
Hmm.
with that short Japanese lyrics, because it's more or less the same art. You need to be able to prepare, like in 2 sentences, you need to explain to decision maker what are you asking for, what is the outcome, and then the decision is.
What's
Uh,
that?
Can you hear me?
Paulo,
yes,
yeah, go ahead.
Oh, finally. Guys, I am on mobile and it's 45 minutes that I'm waiting for this moment that never comes. Open the questions. I'm listening very carefully, guys, all the conference. The question is just one. What do you advise and why? Yeah. The rest is just opinions. Yeah. What do you advise and why? What should we do as an approver?
absolutely.
And I would like to, because I don't want to take the too much time here, but data. What are we doing with the tons of data we have here around? I hear the discussion is going on. Okay, you were challenging the classic ways of doing, and I liked very much the dialogue when it was challenging the way of doing. But what is the nowadays the role of the analysts? So is it more we're surrounded by data? What are the data that are more relevant for a credit decision? Are we using the same? Are we enriching the spectrum, which I believe we should? And are we going more also into how is the customer doing with his stock? Now, yesterday I was relying on sales going visit the old-fashioned ways and checking if the shelves of the customer or the warehouse was empty, full. Now I can get this information real time. Yeah.
Yeah, yeah.
So this is another parameter to be considered. Uh, data. What are the data? What is the data we have, and how can we treat it? Because this is my actual challenge. Yeah. what
Yeah.
is what was yesterday is relevant today, but I'm more interested in forecasting what will be tomorrow with the data that I have today, because I have the chance to get those data.
Yeah. So
Yeah.
so Paolo, thanks again for the input. Andrew, for me, just as okay, the ecosystem that's changed over the last few years, everything is now going online, which means that there's a cost to your business to adapt to that, as you should be adapting to the change in how you process data. And just as you have to have more IT infrastructure, part of physically, you have to have more data infrastructure in the back end. So you have to have the facilities in your development and in your IT backbone to distill the data into more and more relevant information. All of us have got data, but it's up to you to turn that into information. And then you have to convey that information to your executive team, whether that's an individual manager, a finance controller, or a wider credit committee, so that they can make a robust decision. So you would have to put up, I suppose, getting to work and saying, I have all of this data. What are the main triggers that I have important, that I consider that's important? If you have, you've got to be able to filter out a lot of noise. So, for example, getting, small claims court findings on a small business, on an SME, that's important. But to a large corporate, they get 10 of those a day. So that's irrelevant to you. Changes of ownership, those are the sort of things that you want to find out. But you've got to get the machines, you've got to get the big lumps of shiny tin and plastic to do a lot more work for you. Andrew, one topic I think is going to be interesting for us is how will ChatGPT and other such platforms put credit analysts out of a job? I don't think it's going to happen for a long time, but it's something you've got to be wary of. But Paulo, you have to start designing and implementing the data infrastructure that can take that all of that data points and distill it to information that an analyst can use.
I will, if I may, Paolo, I think you got very relevant topic, because I just want to say what I would used to say. Please, I mean, don't get me wrong. I'm fond of automation, and I'm fond of automatical working with data, because otherwise it's impossible to work. Credit management itself could not operate without automation. We got our job because it was possible to automate that job. Like, without ERP system, we cannot simply say we don't ship to this customer. And if we cannot do that, this means that there is no credit control. This is it. It's pretty simple. But when you mentioned in your question, Paolo, please bear with me, is that you are more interested about focusing the data. And this is extremely important thing to mention to everyone. What we started today with in our discussion with Brad is that, every number we use for calculation of ratio is not a constant, it's a distribution. Therefore, creditworthiness of a customer, whatever way we reflect it in the end, is nothing more than a focused. Is nothing more that we believe that credit risk of this customer will continue to be like this because we are either extending trend or we are moving somehow, because we need to rely on something. The problem is we cannot take a decision, say we cannot rely on anything because everything is like in the dust or something. No, we need to make some. We need to have a little bit of certainty to rely on. Although we understand that the floor under us is actually, floating a little bit, but at least we can stand on it somehow. So, long story short, every creditworthiness analysis is actually a focused, and therefore stress testing is a focus which make it much more precise. And I do believe that the collection of data should be either outsourced or automated, but making sense of data. What we were just about speaking, like, synthesis of data, synthesize the conclusion, what we're supposed to do, or just synthesize the conclusion, how much creditworthiness is, creditworthy our customer is that really a job for a people? And that's okay. One thing is getting data, and as Brad rightly said, but there is white noise in that data. Making sense of this data is another job which must be done by analysis, and then use this data, use the result of this analysis into a credit decision. So put that analysis into the credit terms. Again, Brad, we are on the same page absolutely with that, because creditworthiness could be low or be big or low, but then credit terms must be relevant to that, must be adequate. That's comment from my side. Paolo,
Yes.
I'm keeping you waiting that long. And next time, please don't be that shy, or just type your question in that.
Yeah. Thank you, Andre. It's just because I cannot type with my mobile. For some reason, the chat disappeared and I cannot
Uh,
find it. So that's why.
I can only apologize on behalf
And
of Zoom
no,
and
no, no, nothing to apologize. I think we are in a circle of friends here. Thank you very much. What I was trying to point at is the next level of the credit analysis, because of course financials. To reply your point to your initial point, we need them, especially we need the classic tools, especially when you onboard
yeah.
a new customer. But when you have a relationship with with one customer, then this the horizon changes, and sometimes also quite a lot, because you have access to much more information potentially. And as Brett says, now probably this is the challenge I'm facing these days, is just to navigate through the data and find the right ones that they convey a message that is relevant for a credit decision. And this is the ultimately, in my eyes, what makes the difference, what makes the analyst and the job of the analyst much more interesting these days. Yeah, what makes the difference from a simple report and a job, a thorough job. Yeah, my 2 cents. Yeah.
I mean, it's not 2 cents. I think this $2,000 at least. Brett, would you add something?
Try that again. Yeah. So, Paul, I think what we have to do, here's the thing. COVID was a bit of a mixed blessing in that it shook up the way we did things, and every prime minister, president, CEO, shareholder investment, all the way down, was interrupted. And I noticed that there was a great deal more openness with a lot of customers who would traditionally not want to supply information. They started to do that. With the data analytics and what you're doing, I would say just experiment with stuff. If you have, for example, a decent Microsoft corporate subscription, there are some amazing tools in there in SharePoint that you probably have, business automation, Power BI, that you're probably paying a subscription for that you don't use. Take a couple of courses. You can probably get this free or at modest cost over, let's say, LinkedIn Learning or Udemy or one of those places. Get to know data, because as you look at credit posts now, the traditional idea of credit analyst, that's just a given. What's going to set credit analysts apart from the pack is being data savvy and proper data savvy, knowing how to change things, sitting in a meeting and saying and hearing your CFO or your chief of commercial in a particular region saying, if I discounted my top 10 customers by 5%, what would be my earnings? And bang, 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 you could do that real time on the call, on the presentation. You're not having to go back. If you can start doing that. So what that means, Polo, is there's going to have to be a point of your own sort of development or your company's development to get experimental, to try a few things, to support the failures, bring learnings out of failures, and just say, how can we adapt to this flood of data and make it work for us? Because you've probably got a lot more there than you think.
You see, I just add, Paolo, thank you. It's important topic, but again, when we speak about the reality out there, when we speak about analyzing financials, there's one good thing to know, that sometimes they're not available, like in United States. Another good thing is that, I mean, I don't say it is a good thing, but another thing to know, Swiss Association of Credit Managers did a research, and what they found, that 45% of Swiss companies simply have no idea about the creditworthiness of their customers. And we are speaking about customers who extend credit terms. We're speaking about companies who extend credit terms. So it's just like, one is crying they have no shoes to play football. And then, like Zinedine Zidane said, and then I've seen a person who has no legs. And I understood how happy I am. So first of all, let's thank God we got credit analysts. That's all. But another important topic to get here, that's where we started with Brad today about this obsolete financial statements and the COVID. During the COVID, I was telling my clients and to some of my prospects and some students who came to my course, I said, look, what COVID says us is that if you didn't start to do a credit analysis before the COVID, mere credit analysis during the COVID would not help you, because the problem with the COVID, there is a dramatical change, and these dramatical changes will be happening every day. So this means that we know that creditworthiness analysis is always outdated due to data.
Yes.
Due to data. So we're supposed to look based on the data, look forward again, focused in, as Paolo rightly said. And one of the topic about analysis, sorry, I will do my last lyrical story about that. How many big events was predicted by the data, like 9/11, like 2008 crisis and everything? I mean, 2008 crisis might be that, but the thing is, too many events, too many impactful events was not predicted properly because people, they're just looking at the data, not using their imagination. That the principal difference is that good credit analyst is supposed to have an imagination, imagine in what situation negative event could happen. That's why we come into the synthesis where we come into the synthesis, not analytics. And that's why we say that, so far, automated data could not, and automated analysis of the data is one thing, which gives a background. And then analysts supposed to come with his or her judgment and imagination and really do a real job, forward thinking, forward looking. That's what we speak about credit analysis. And technically, I mean, more, let's say, legislatively, if you wish, more formally, we finally got that move with IFRS 9, where the credit risk was turned from the past to the future.
Mm.
That's the idea. Credit risk is there. I mean, negative of the events, if they could happen, out there. So we should not stop looking to the past only. We need to take into account past and look into the future. That's I believe we got that combination of human being and artificial intelligence together, which should make us much more successful in business.
Exactly.
Okay, since we don't have any more questions and we're already 2 hours live, Brett, I do thank you very much for coming. Thank you very much for finding, for wasting at my unclear idea, your Friday night. I believe okay. It's not that late in UK still, so
exactly.
And thank you very much for everybody, to everyone who found it is possible to do the same thing as Brad did. And I'm really grateful to you. I wish everyone, as usual, higher sales, lower spendings and losses, or as it could be said, in the French-speaking environment I live in, bon crédit. Indeed. Speak to you soon, and
thank you.
Thank you so much, Brad and Henry.
Thank you. Don't forget to come to the next credit chat. Brad, thank you.
Thanks again.
Yeah, have a nice weekend.
Ciao.
Ciao, ciao.